We're often asked, what are the benefits to owning life insurance inside your corporation? Here are 5 pro tips to owning life insurance inside your corporation. Number 1, you can pay the cost of insurance with corporate dollars, which is better than using after-tax personal dollars. With the small business tax deduction, you're taxed at 11% as opposed to your personal rate, which could be as high as 50%. This leaves you with more buying power for the insurance and, as a result, more money in the corporation to grow and invest. Number 2, all or nearly all corporately owned life insurance proceeds are paid out tax-free through the corporation's capital dividend account to the shareholders. Just make sure the corporation is named as the beneficiary and the shareholder is named as the insurer. For example, if I were to die tomorrow, my life insurance will be paid out to my corporation. As I am the shareholder of my corporation, my family will be able to access the money tax-free. Number 3, corporately owned life insurance can help with estate tax or final taxes upon death, and it can help to equalize what each beneficiary receives from the deceased. This is also known as estate equalization. Consider a situation where shares in a family-owned corporation form a major part of the value of a person's estate, and the estate has multiple beneficiaries, such as a wife, a son, and 2 daughters, some of whom are not involved in running the company and don't have any interest in the running of the company. Corporate-owned life insurance can help pay for any final taxes and ensure each beneficiary receives what the deceased intended them to have. Those family members interested in keeping the business would receive their share of the estate in the business's value, and those family members not interested in running the business are compensated with the proceeds from the life insurance. Number 4, buy-sell agreements. In this case, life insurance can be used to buy out a deceased shareholder's family member. Here's an example. Let's say Karen and Becky own 50% each of a business together. Now, although Karen and Becky have been best friends for a long time and do get along with each other's respective spouses, the idea of running the business with one of them isn't ideal. Let's say Karen unexpectedly passed away. Her shares of the company would pass to her spouse, and Becky would now be in business with them. In many cases, the surviving shareholders, Becky, is not interested in having the deceased partner's family involved in the business. And those family members, in this case, Karen's spouse, may not be interested in staying involved in the business. Corporate-owned life insurance can solve this issue by buying out or purchasing the deceased owner's shares from their family. In this case, Becky can run the business as she pleases and retain 100% ownership, while Karen's spouse can use the proceeds as selling the shares as they see fit. To avoid confusion and potential conflict later, the buy-sell agreement process should be documented in the shareholders' agreement. Number 5, you can use life insurance as an investment. Investments inside corporately owned tax-exempt universal life or whole life insurance policies grow tax deferred. You can use the money from these investments to supplement retirement income when you're ready to step away from running your business. If you're a business owner and you want to make the most of your corporation to get further ahead, book a call. We'd love to help. Thank you.